So the idea is we're going to take all those cash and cash equivalents and determine how the change from the beginning cash to ending cash, how that change occurred. Did it occur from our operations, from our investing, or our financing activities? And then there's also non-cash activities, and this really throws a lot of people off. But what happens when we dispose of assets, right? If we dispose of an asset, we don't sell it, it lowers our balance sheet. We might take an income or a gain or a loss on it, but it has no cash effect. So we have to check for those kind of things. And any non-cash investing, financing, or operating activities, normally non-cash activities are investing or financing. Any of those non-cash kind of transactions, we have to disclose on the statement of cash flows. Say, hey, just so you know, we did make some of these major transactions. Here they are, but they aren't reflected above. So the statement of cash flows includes these following sections. You should remember this: operating, investing, and financing, right? So you can think of it as OFI, right? Operating, financing, investing, OFI. OFI is kind of the way I remember it. But the layout is generally operating, investing, then financing. And just memorize this. You need to know this for all of your education, all of your future education. And the one piece I'd add here, right, is let me enable my editing. Non-cash. So I'd say this is actually 4 sections. Non-cash transactions. And those would be disclosed at the bottom of the statement of cash flows. And I'll show you examples of those later. So this slide explains that cash inflows generally come from cash sales to customers, from collection of credit sales, from receipt of dividend revenue, anything that's the short-term assets that we're going to be collecting from come in, and then we spend the money. Our cash outflows are to pay for our ultimate cash inflows in an operating activity. So the way that I think of this, and I have it in another similar video, is, which I'll switch to that slide deck eventually, is cash flows are related to short-term assets and short-term liabilities. Operating activities, statement of cash flows, short-term assets, short-term liabilities. So if we have accounts receivable, if we make an adjustment to the account receivable, if we collect on that, that's a cash inflow from operating activity. If we have because accounts receivable is short-term, right? If we have a short-term dividend receivable, this is actually in dispute with new guidance, but for the sake of this book, we can think of it as, since it's short-term, we can think of it as operating cash flow. If we have collection on credit sales, that's our accounts receivable. If we got cash from a customer, if a customer just gives us cash, that's related to what would have been an asset, short-term asset. Our cash is a short-term asset, so that's part of our operating activities. We got receipt from some kind of interest revenue related to short-term activity. We can even call that an operating activity. Again, there's some new guidance that disputes this a little bit, but you can think of, for the sake of this book, we can think of short-term assets, short-term liabilities as operating activities. From the liability standpoint, like wages payable, accounts payable, our expenses to buy inventory, our movement in inventory, all of these things are related to short-term assets and short-term liabilities. That's what I want you to think. If you see a short-term asset, you see a short-term liability, then you're going to go and assess it as an operating activity. Investing activities, like, again, I can make this really complex for you and you can memorize every single piece. Like, oh, okay, we have intangible assets, plant assets, long-term investments, collection on principal and notes receivable, selling and discounting notes. I don't want you to worry about that. You can generally think of investing activities as the sale or purchase of long-term assets. The sale or purchase of long-term assets. That's what I want you to think of it. There's a small exception for selling short-term investments, but most companies don't have this, and most short-term investments we're just going to consider as cash or cash equivalents because we have that 3-month exception. So I don't want you to worry about that one too much. Just think default, if it's a long-term asset, it's probably an investing activity. So if I'm going to go buy a warehouse, it's going to be an investing activity, outflow, cash outflow. If I sell the warehouse, it's a cash inflow from the investing activities. If I buy some stock, long-term stock, it's going to be investing activity outflow. If I sell the stock, it's an inflow. Same thing with financing activities. So we've gone over short-term assets and liabilities. We've gone over long-term assets. All that's left is long-term liabilities and equity in the accounting equation, right? Long-term liabilities and equity. So long-term liabilities and equity, how we go around that? What are those kind of inflows? Well, equity is influenced by issuing stock, treasury stock, and then contributions from the owners, right? If we buy or give the company money. And then liabilities are if we issue debt. And then our outflows are if we pay dividends to the shareholders, if we purchase our treasury stock, if we take withdrawals, or if we pay off our long-term debt or short-term debt. So the idea here is any of these long-term liabilities or equity accounts are going to be financing activities. I don't want you to get confused by these short-term pieces here because it's so unusual for us to issue short-term debt or short-term or buy short-term investments. And I won't expect you to be tested on that in this class. Just be aware of that if you get a one-off like homework question. The last piece is, so to recap, right? I want to keep it simple. What are operating activities? Short-term assets, short-term liabilities. What are investing activities? Default to long-term assets. What are financing activities? Default to long-term liabilities and equity. That's it. Super easy if you think about it in that framework. And then now I want to discuss the why behind that. Non-cash investing and financing. What are some examples of this? We talked about a few before, but if we retire debt by issuing equity stock. So, right, this happens a lot in Silicon Valley, right? Hey, instead of you retiring your debt, instead of us paying you the $1 million we owe you, we'll just give you some stock in our extremely high growth company. Investors love that, and that's very common. There's conversion options. That's much more complex accounting. We'll get into that eventually in advanced accounting. Conversion of preferred stock to common stock. For changing the type of stock we have, there's no cash involved. End of the day, easiest way to think of non-cash is it's no cash, right? There is no cash involved. If you think of any transaction and you can't figure out if there's a debit to cash or a credit to cash, it's a non-cash activity. So we talk about purchasing of long-term assets for debt. We discussed that previously. But if we lease an asset in a capital lease transaction, we didn't pay cash for capital leases. We'll get into another advanced area of accounting, but you have an asset and a liability related to those, and you don't. There's no cash related to it generally. Purchase of non-cash assets by issuing equity or debt. So I think you get the idea here. If you don't see cash related to if you can't specifically identify a cash income or outflow, then it's a non-cash activity.